Today, we are going to talk about the topic of negative impact of derivative. To fully understand how the financial crisis happened, we will need to trace back to how it all started. Mortgage-backed securities, also known as the MBS, a type of asset-backed securities secured by a collection of mortgages.
There are a few types of MBS, but this time we are going to be focused on mortgage bonds and collateralized debt obligation, CDO. Mortgage bonds is a debt securities mainly issued by the banks, usually backed by a pool loans issued by the banks. The interest payment from the loans will be used to pay investors who bought the bonds. Investors will bear the losses if the bonds default, while the banks only act as the intermediaries between borrowers and investors. CDO is type of a structured financial product that pools cash flow generating assets and repackages this asset pool into discrete tranches by different riskiness that can be sold to investors. CDO allows corporations and banks to sell off debt and free up the capital for reinvestment or loans. The concept of CDO is that even if the assets behind the bonds are risky, by pooling large amounts together it is possible to reduce risk and increase returns, which the returns are in terms of interest rate. After the 2008 crisis happened, most people think that the MBS are the root cause to this catastrophe, but it's the human society ultimately causes this. MBS products itself, if priced correctly, is a really stable and secured financial product. But how can such a product be the devil behind all this? The real issues starts to comes in during the early 2000s, which popularity of MBS began rising. Due to insufficient supply of loans to fills up the MBS, loan issuers start to lower the credit requirement for loans, and these risky loans issued is what we call subprime loans. Subprime loans is again bundled with thousands of other mortgages to form more MBS. And the percentage of subprime mortgages contained started rising. Due to the diversification element, rating agencies are still ignorant to the changes and gives a high rating to these securities. Due to easily accessible loans, people started buying more houses. House prices started to rise and more investors started to buy MBS. Rising house prices also give the investor false sense of secured protection of the MBS, as they presume even the mortgage is defaulted, they could still sell the property in profit. MBS issuers started to pay money to securities rating agency for giving high rating to MBS, such as mortgage bonds and CDO issued by them. This create a very huge problem for insurance agencies, derivatives issuers and banks to price and calculate the risk of the MBS default insurance, credit default swaps CDS correctly. Thus, not only that the premium charged on these swap are low compared to actual payoff, the issuers also issued a lot of these swap into the market without having enough reserve to back it. When the Fed rate started rising from 2004 to 2007, a lot of subprime loans started to default and mortgage issuer filed for bankruptcy. Most of the mortgage-backed securities began to fail, and making the matter worse, CDS issuers have to be responsible to all these losses, and due to that a lot of large financial institutes were not able to meet the debt obligations, causing many financial institutes either got bailout by government or file for bankruptcy like Lehman Brothers. Stock market starts to tumble, and due to large amount of houses were suddenly out to the market for sales again, the property started to drop rapidly and the economy officially entered into a recession. As mentioned above, one of the derivative products that are involved in the financial crisis is credit default swap, which is known as CDS in shorts. A CDS is a swap contract between two counterparties to exchange the risk of default associated with the loans. One party will make premiums payment periodically to another party to secure the repayment of the underlying debt the CDS insured. CDS is normally purchased by lenders from protecting themselves in the event of default on the part of borrowers of loan by transferring associated risk for periodic income payments. The default events including bankruptcy, failure to pay and restructuring. Another derivatives are synthetic collateralized debt obligations, which is known as synthetic CDO in shorts. Synthetic CDO is the CDO that invests in CDS or the other non-cash derivatives in order to obtain exposure to a portfolio of fixed income assets. The CDO is split into different risk classes known as tranches, and each tranches is assigned a different payment priority and interest rate. The Class A tranche with higher S&P rating will lead to lowest yield, whereas the equity tranche would have the highest yield as it is the most risky component. Although CDO is split into tranches with top-rated tranche which is AAA and the bottom tranche being rated as junk, but they are all actually based on the same asset, which is the worst subprime mortgages from a large mortgage pool. Federal Reserve stepped in quickly and offered emergency loans to banks to prevent fundamentally sound banks from collapsing. The government also enacted a program called Troubled Assets Relief Program, which is known as the bank bailout. The government prioritized on rescuing prominent financial firms and followed by injection of up to $100 billion into each housing agencies to prevent such cases to happen again. The Treasury also conducted stress tests on the largest Wall Street banks. Government accountants swarmed over bank balance sheets and publicly announced which ones were sound and which ones needed to raise more money. From all the past events occurred, we can learn from the lesson that will be beneficial to us in the future if something similar happen again. The amount of risk taken in one's investment portfolio will capture a significantly greater degree of attention in the years ahead. The blind pursuit of profit with no thought to the downside is a strategy that failed spectacularly. Protecting what you've got is just as important as trying to get more. Keeping one eye on risk and the other on growth is a lesson worth remembering. Experts don't know everything. We put a lot of trust in experts, including stock analysts, economists, fund managers, CEOs, accounting firms, industry regulators, government and a host of other smart people. They all let us down. A great many of them lied to us, intentionally misleading us in the name of greed and personal profit. Even index fund providers let us down, charging us a fee for the privilege of losing our money. You shouldn't buy what you don't understand. The marketplace is filled with complex and exotic offerings that promise the world to investors. Derivatives, special investment vehicles, adjustable rate mortgages and other newfangled investments that may be too complex for the average investor racked up huge fees for financial services firms and huge losses for investors. Next, you must know your own bottom line, so you will not overstep it. If your investments are doing well and you get a good run, rebalance to remove risk. If the markets have fallen as far as you can stand, take what you have left and get out. You should know your risk tolerance and know how much damage you have the stomach to take. Imagine if you are in the same situation as them, how would you handle it? First, the government and Federal Reserve Board must prevent the collapse of working capital by supplying short-term loans and taking other measures to sustain the commercial paper market, interbank lending and the smooth functioning of money market funds. Second, to ease the repayment terms on existing mortgage holders, to reduce the flood of defaults and foreclosures that will otherwise occur. Third, to encourage expansionary monetary and fiscal policies abroad, so that the decline in U.S. consumer spending is smoothly offset by a rise in spending in other countries. This overseas expansion would allow the U.S. to offset the fall in their exports to the U.S. by a rise in their internal demand.